Hi everyone, my name is Kyla Scanlon. I want to begin this video by saying that there is nothing but uncertainty right now and there is barely any trust. It's a lot, it's hard to cut through the noise and it's even harder to interpret signal, but this is our reality and we have to understand what's going on. And one thing that I've been obsessed with recently is data. Data methodology, survey design, data interpretation, all of it. Data is key to how we understand the economy, and sometimes it doesn't make any sense. And that's concerning for how we develop monetary policy because that influences the economy at large. If the data sources are flawed, does that mean the policy itself is flawed too? And so today we're going to talk about economic data, where it comes from, how we understand it, and why it's becoming increasingly difficult to discern its patterns.
We're the data dogs. And the thing is, the first rule of the data dogs is there's a time for walking and there's a time for sniffing. And when there's more noise in the data, that's the time for sniffing.
That's Austan Goolsbee, president of the Federal Reserve Bank of Chicago. He was born in Waco, Texas, and was announced as the 10th president and CEO of the Federal Reserve Bank of Chicago on December 1st, 2022. But let's start this conversation that we're going. And so we're going to talk to him about economic data, how the Federal Reserve thinks about the flaws in economic data. And we're going to begin with a seemingly deceptive type of question. How much is the cost of living in the United States of America? You might think this is relatively straightforward. It's something that we talk about all the time because, after all, millions of Americans, yourself included, pay rent, buy groceries, and fill up their gas tanks every single day. It can't be that hard to measure how much it costs to live. But as President Goolsbee explains, measuring the cost of living is anything but simple. Take, for example, housing. It isn't responding to interest rates the way that economists expected. So you said in a recent Marketplace interview that it would be hard for you to see that we could get to the 2% overall target for inflation unless house prices inflation comes down substantially from where it is right now. So considering that housing is, pretty much the main driver of inflation right now, what do you think about the housing market overall?
The conventional wisdom was always one of the main transmission mechanisms of monetary policy. One of the main ways that the Fed raising the interest rate slows things down is through the housing market. We've rediscovered this thing that it doesn't just affect the demand for housing, it also affects the supply of housing. Since that's always true,
shelter has been a huge inflationary issue. As of April 2024, shelter made up 36.1% of the CPI, the most commonly followed US inflation measure. It's 15.5% for PCE, the Fed's preferred measure of inflation.
I think that this time is a little bit different in that the rates were so low for so long that in a way you have more people locked in with these low rates that at least on the margin, they're thinking, I'm not going to move unless I have to move because the new mortgage that I'm going to get is so much higher than the one I'm at now.
This is the lock-in effect, also known as golden handcuffs, people tied to a place with a 2% mortgage. People don't want to move, and that has froze up the housing supply. They're trapped by a good rate. Goldman Sachs quantified this effect. They found that for every 1 percentage point increase in the gap between market rates and existing mortgage rates, homeowner mobility drops by 0.8 percentage points. From 2021 to 2023, that translated to a 2.7 percentage point drag on mobility. People weren't moving because they were locked in.
That's still just a temporary phenomenon. Over time, that's going to phase out. People are going to phase through their mortgages. They'll have to move, etc. So partly that one's going to work itself out over the business cycle.
So like most things, time heals all wounds, but the data is bizarre. The way we measure housing inflation is based on rents, not home prices. And there's a significant lag between what's happening in the real world and what shows up in the official statistics. The Consumer Price Index uses two main components to measure shelter cost: rent of primary residence and owner's equivalent rent, also known as OER. While rent of primary residence reflects actual market rents, OER is a little bit trickier to figure out. It's an estimate of how much homeowners would pay to rent their own homes. However, OER tends to lag behind actual market rent changes, creating a delay in how housing market shifts appear in inflation data. This lag can be significant, sometimes taking 6 to 12 months for market rent to trend. This lag can be significant. Sometimes it takes 6 to 12 months for market trends to fully reflect in the CPI. And as a result, CPI shelter costs can appear out of sync, and they are, with real-time housing market conditions, complicating inflation analysis and monetary policy decisions.
When I said the thing about inflation, this mechanical of how we add up the inflation rate for housing being based on rents, and that the market rents were down, but the official series wasn't down. And you've started to see in the more recent data that beginning to decline. That's part of my optimism, I think, about 2024, that there still could be some more progress to be made on inflation, because eventually we should start seeing what we already witnessed out in just the market prices.
The Boston Federal Reserve recently published a paper on this topic with the title A Faster Convergence of Shelter Prices and Market Rent, Implications for Inflation. They found that if shelter prices were excluded from inflation calculations, monthly core CPI inflation rates would have ranged from 1.8 to 2.4% from July 2023 through February 2024. But actual core CPI inflation rates over this period range from 3.8 to 4.7%. That's a difference large enough to significantly impact monetary policy decisions because of housing costs, because of a lag in the data. And the Federal Reserve thinks about this.
So the supply part, I do think, is important, but it's more of like a medium run thing. And my puzzle is really about the short run, and just like, why does this not add up?
The discrepancy between what's happening in the real world and what shows up in official statistics is at the heart of the data challenges facing economists today. And it's not just about housing costs. In recent years, we've seen an explosion of new data sources. Companies like Zillow and Redfin provide real-time housing data. Credit card companies offer insights into consumer spending. Even satellite imagery is being used to track economic activity. But this wealth of information comes with its own set of challenges. You have these real-time data sources from Redfin and Zillow that are pointing to rents going down. But when you look at the CPI or the PCE, because of the way that we calculate rents, it's not going down. So how does it...
No, and so then what do you do? And
it's
what do you do? One of these where, as you've written about, in people's ordinary experience, they're deeply suspicious of price indices to begin with. You know, everybody's looking and like, well, my rent isn't down, so I don't know what they're talking about. The explosion of private sector data sources that we can look to kind of cross-check what's coming out in the official statistics, and that we can look at in real time and not have to wait a week, a month, a quarter to get the information. 99% have been wonderful. It's enhanced our ability to get a handle on what's happening. 1% have added frustration to our lives.
And all of that's new. It's tough to figure out what to do with it. Where do all these data sources fit into the broad tapestry of analyzing the economy? What's right and what's wrong? What do you do when nothing really makes sense? How do you ask a proper survey question? How do you make sure that surveys aren't creating bias? How do you make sure that the methodology makes sense? How do you make sure you're capturing economic reality?
Because then when we start to see persistent divergence between them, we don't really know what to do, because we don't have the historical experience on Redfin or Zillow or some of those to compare.
It's extremely difficult. This data revolution has created paradox. On one hand, we have more information than ever before, more knowledge, presumably. On the other hand, it's becoming harder to know which information to trust. We already live in the gray area of a post-truth society where nobody believes in anything anymore. And if the data is showing holes, that makes economic communication that much harder. If nobody believes in anything, how do you do anything? Take, for example, the Job Openings and Labor Turnover Survey, or JOLTS. This survey, conducted by the Bureau of Labor Statistics, provides crucial information about the labor market. But as President Goolsbee points out, it's facing challenges. It's like survey methodology is getting a little bit funky, like JOLTS, the Job Openings and Labor Turnover Survey. People just aren't responding to that at the rate that they used to.
Well, look, just ask, are you responding? People call you at dinner, they're ringing, I'm calling from a pollster. No, you hang up. But that impulse that nobody wants to answer their cell phone if they don't know what the number is, that's having for sure a bearing on how we understand the economy. How do we read the job market? Because the JOLTS data, even the CPS, the response rates are going down, and that just adds variability.
The decline in survey response rates isn't just a minor inconvenience. It can lead to increased variability in the data, making it harder to discern true economic trends from statistical noise. And it's not just jolts. The University of Michigan Consumer Sentiment Survey, a key indicator of economic confidence, recently switched to web-based collection from calling people on the phone. While this might increase response rates, presumably, it also introduces new variability into the data. While this might increase response rates, presumably, it also introduces new variability into the data and is the reason that we saw a swing in the metric the last time that we got the print. The way that we collect information matters.
It doesn't have to mean that it's biased. It just means you should get ready to buckle up to have some more noise. Whoa, what, prices are up a lot for this month and the next month they're down. We're going to see a lot more like that.
Oh, wow. So you think we're headed toward potentially more volatility just because the data sources
Yeah, I think you kind of have seen that in a lot of the series where there's a mad scramble, a number comes out, and then a mad scramble, and they find out, well, we haven't been taking into account properly the amount of immigration, and so now we're going to have to go back and try to subtract off the number to say what was steady state. And you see it on prices, you see it on housing, you see it in services, you see it in a lot of places.
And so for a data dependent Fed, that presumably makes your job a little bit harder.
So the Fed's got to be forward looking. It can't just look at the data. And the private sector data help us to do that because it's a little more real time.
Yeah. And this is why the role of the Federal Reserve is important. Who knows what's happening? And this is why the role of the Federal Reserve is important. It's about looking beyond the headline numbers, digging into the methodology that underlies the metrics, and understanding where the metric fails in communicating what is going on, like jolts. The survey response rate has collapsed. The quits rate is probably a better indicator of the strength of the labor market. You have to sniff the data before you walk the path. Because the Federal Reserve, who manages monetary policy through raising and lowering interest rates and shrinking and expanding their balance sheet, basically setting the course for the entire economy, has to be particularly careful in how it interprets data. That's why they look at a wide range of sources, as President Goolsbee explains.
Ultimately, the Fed cannot be purely backward looking. So the worst monetary policy rule you could devise is just look back at what happened to inflation last month and base your decisions on that. You can get yourself into a little bit of a pickle because we know that there are some things that are good leading indicators and some things that are not good leading indicators.
This distinction between leading and lagging indicators is crucial. There are three types of indicators. There are two types of, so leading indicators point to the future, lagging indicators point to the past. Leading indicators like new housing starts or the yield curve can signal future economic trends, whereas lagging indicators like unemployment rates or corporate profits confirm long-term trends. Unemployment is backwards looking. We can't really use it to chart a future path, but we can definitely use it to figure out where the economy is and where it could potentially go. But it's looking at the past. It's not really telling us about the future. But even among economists, there's debate about which indicators fall into which category. For example, take wage growth. Many people worry that rising wages will lead to inflation because if people have more money, they'll spend more, right? And won't that drive up prices? And part of the worry is that wages have outpaced inflation, believe it or not. Since February 2020, the Consumer Price Index has climbed a cumulative 20.8%, according to the Bureau of Labor Statistics. Over that same time period, average hourly earnings rose 22.3%. The Council of Economic Advisors wrote, yearly wage growth has exceeded price growth for 15 months in a row. Over the past year, nominal wages rose 4.2% for these mid-level workers, while inflation was up 3.3%, leading to real wage gains of 0.9% over this most recent period. And it's about who it impacts too. Cumulative wage growth since the start of the pandemic has outpaced price growth across the wage distribution, but the most wage growth has been among lower wage workers, as the Bank of America wrote. Young people are earning higher inflation-adjusted real wages than any previous generation at the same point in their lives. So we're seeing wage growth, and we're seeing it in areas that we wouldn't expect. We're seeing it across lower-income consumers and for young people. But President Goolsbee says that wage growth is not a good leading indicator of prices.
Wages tend to move more slowly and less frequently than prices do. So when things hit us, tends to be prices go up, then wages go up, then prices come down, then wages come down. There was a feeling of some smart people at the beginning of 2023, not only that there would be a recession, but that wage growth was so high that there's no way inflation could come down.
President Goolsbee warns about the dangers of focusing too much on wage growth when making monetary policy decisions.
And if you were applying a monetary policy rule, let's call it, which said, I'm going to keep slamming on the brakes until wages come down to a growth rate that is compatible with 2% inflation, you will almost certainly overshoot the target.
The Council of Economic Advisors also wrote, none of this good news contradicts the fact that prices are still too high and that we must therefore build on the progress documented herein. Just to caveat all this, things can be improving, but they still need to get better. The important thing is that there's progress. It doesn't mean that things are perfect. There's nuance to these discussions, which is frustrating, but it's how it has to be. This lag between wages and prices is just one example of the complexities that the Federal Reserve has to navigate. But amidst all this uncertainty, there are moments of clarity. President Goolsbee points to 2023 as a particularly successful year in terms of monetary policy.
You got to look back and say 2023 is one of the best dual mandate years in a very long time, where inflation fell almost as much as it's ever fallen in a single year, and there was no recession. That's virtually unprecedented.
It seemed like the Fed had found its golden path this year. Their preferred inflation measure, personal consumption expenditures, was getting closer and closer to their 2% target. But then came January 2024 with a spike in inflation that caught many off guard. The culprits were an increase in shelter costs, as we talked about, auto insurance, which went up astronomically, mostly because Americans were getting into more crashes, and those rates were just catching up with the movement of rates over the past few years, and medical care services. It was a reminder of how quickly the economic landscape can shift. Do you think we've strayed from the golden path?
When inflation was too high in January, it followed 7 fabulous months where we were at our 2% inflation target for 7 months at the end of 2023. And I was growing in confidence. Hey, maybe it's done. Maybe this is the path. Then we hit a bump in January of a truly bad inflation reading. And then our whole efforts got to be figuring out, is that a sign that the economy is overheating, or is that just noise or a blip?
A lot of the inflation recovery that we had was due to supply chain normalization. The Roosevelt Institute estimated that 79% of disinflation was driven by supply expansion, and that's largely recovered.
I don't think if you look at the real economic conditions, or if you go talk to businesses and people in the community, like the kind of information that the Fed puts out in the Beige Book, this doesn't feel to me like a traditional overheating, but that concept of, is there still a little magic golden dust that will go into 24 after the supply chain is fully healed, which was a lot of what the benefit in was. I'm still closet optimistic that there will be. I think if we get some more decent readings on inflation, that would convey a message, to me at least, and I'm not allowed to speak for anybody else on the FOMC, but to me, that would make it feel like 7 months of 23, that wasn't a fluke. We're over the broad arc, inflation is way down, and the job market has remained pretty robust.
The constant challenge facing the Fed is distinguishing signal from noise in a sea of data. And it's not just about inflation. As the Federal Reserve Bank of San Francisco President Mary Daly noted, the Fed now faces risks on both sides of its mandate, not just inflation, but also employment.
By other measures, if you look at the quit rate, if you look at vacancies to the number of unemployed workers as a ratio, if you look at a lot of traditional measures of job market health, they're cooling. The level is still pretty strong, but the direction is definitely not toward overheating. It's the other way.
And the labor market has been historically robust, as President Goolsbee said. The American labor market is better for workers than it has been in decades. And in contrast to what you might hear about it, the average worker is working fewer hours and rates of 2+ jobs are down and typical job tenure is up and people are changing jobs less frequently. But this now cooling labor market presents its own set of challenges. How much cooling is too much? And what point does a soft landing turn into a recession?
And so it's not that they're flashing red, but they're just warning signs. And if you couple that with, for example, there's been a rise of delinquency, consumer delinquency, consumer spending slowing a little bit, again, from really robust levels that were in a way hard to explain down to something more moderated. But directionally, if that keeps going, you would definitely need to start thinking about the other side of the Fed mandate, which is to say the real economy.
The alarm bells are flashing. Everybody knows this. The Federal Reserve Bank of New York reported that credit card delinquency rates rose to about 5% in the fourth quarter of 2023, up from about 3% a year earlier. That's the highest level since 2011. During the pandemic, many Americans accumulated what economists called excess savings, money saved due to reduced spending during lockdowns, combined with government stimulus payments. At its peak in 2021, these excess savings were estimated to be around $2.1 trillion. Savings cushion helped fuel the economic recovery. It helped people go to Taylor Swift concerts. It helped make sure that people were out there spending money. The American consumer has been incredibly resilient, and that has saved the economy. But it's been rapidly depleting. By the end of 2023, economists at the Federal Reserve estimated that these excess savings had been almost entirely exhausted. Some analysts even suggest they've dipped into negative territory, meaning Americans are now saving less than they were before the pandemic. This depletion of savings could explain the rise in delinquencies. As the savings buffer disappears, more consumers are struggling to keep up with their payments, especially in the face of high inflation and interest rates that are at record highs. And that's what we have to pay attention to.
That's why we're in this job. It's not my very first speech when I took over at the Fed. The topic was, we're in this job to care about the real economy. It's not the stock market. It's not the market reaction. Those things can be informative to us, but that's not why we're doing the job. So let's not forget the real side of the economy.
And that's what the Fed is doing. This focus on the real economy is crucial. While stock market performance and other financial indicators are important, they don't always reflect the economic reality for average Americans. The exhaustion of excess savings and the rise in delinquencies paint a picture of consumers who may be reaching the limits of their financial resilience. And people are reaching their psychological limits too. And all this is happening against a backdrop of rapid technological change. Artificial intelligence is reshaping industries. We have immense political uncertainty. Climate change is impacting agriculture and energy markets. So the economy is normalizing, with real GDP on track to grow 1.5% in the first half of this year, down from 2.5% last year. Unemployment is low at 4%, but it's on the rise. But also, the stock market's at all-time highs thanks to 4 companies and NVIDIA. GameStop recently mooned. How does the Fed think about this gap between stock market and economic data? And now I am going to ask you about the stock market and financial conditions, because companies are slashing rates or costs on 400 billion of junk loans. So the FT just recently published an article about that. This is very separate in a certain way, but we had, this weird rally in GameStop. So how does the Federal Reserve think about things like that in context of financial conditions?
GameStop, we try not to get the law forbids me from trading in any individual stocks anyway. And we got a 45 days in advance if you were ever gonna make a transaction.
No moon for you.
so there's no meme. The meme stocks are not my reading. As I say, I think financial markets give us a lot of valuable market information about what are expectations. We can back out inflation expectations of using the market data, which I think is very useful in our trying to understand what's happening. But it's only one source of data. And as you've highlighted, if you take the stock market, there's wide swaths, tens of millions of people in this country who are not in the stock market.
132 million Americans don't own stocks. That's about 40% of the US population.
So it's worth our remembering who the markets are and what information we get from them.
Very few consumers anticipate better business conditions ahead, yet they're increasingly bullish on stocks, again, showing that sometimes the data makes no sense. So apparently we get hopes and dreams and maybe some reality detachment from the stock market. But when we think about how the Federal Reserve influences the economy, we often focus on the federal funds rate, the short-term interest rate that the Fed directly controls. But as President Goolsbee explains, the reality is much more complex.
If you look at financial conditions, it is totally fair to say that one of the things that I, as a member of the FOMC, or if you go back and look at the transcripts of past FOMC meetings, what they look at financial conditions separately from just the short interest rates that the Fed directly controls or influences.
But what exactly are financial conditions? When we talk about the stock market, when we talk about the bond market, think of them as the broader environment in which economic decisions are made. They include things like long-term interest rates, stock market valuations, credit spreads, and the value of the dollar. These factors can sometimes move independently of the Fed's actions, creating complexity and uncertainty. So when the Fed raises short-term rates, it doesn't just affect the cost of overnight borrowing between rates, it ripples through the entire economy.
And so in a way, that tightening is affecting the economy, is affecting business investment, is affecting people's decision to buy a car or buy a washing machine or anything where they might get a consumer loan.
But here's where it gets interesting. The relationship between short-term rates, which the Fed controls, and long-term rates, which it doesn't directly control, isn't as straightforward as you might think.
If you look at all the past rate tightening cycles since like 1953, when the Fed tightens short rates, I think it's a mistake to expect that long rates should have gone up by as much as short rates went up. That's not the right measure. That has basically never happened. Historically, long rates go up by about 1/4 the amount that the short rates went up. And this time it's been more than that. There is a sense in which financial conditions are tighter now than you would have even expected, given what we did with the interest rates.
This is really important. In the most recent tightening cycle, long-term rates have risen more than historical patterns, which suggest this means that financial conditions are actually tighter than what Fed actions alone would predict. Why does this matter? Well, many important economic decisions, like whether to buy a house or make a major business investment, are based on long-term rates. If these rates are higher than expected, it could slow the economy more than the Fed intended.
So that's the long way to say, I think we should look at financial conditions and be respectful of financial conditions, but let's not be scared of financial conditions.
And this sort of communication is everything. And one of the Fed's most closely watched communications is the dot plot, a chart showing where each Fed official thinks interest rates should be in the future, and the market's interpretation of these projections can diverge wildly from the Fed's actual intentions.
We have had periods in which, for example, in last December, the summary of economic projections, the SEP and the dot plot comes out, and the median dot said that they expected there would be 3 rate cuts in 2024, that they projected that would be appropriate.
Yeah.
And the market immediately concluded, well, that must mean 7 cuts. And so you saw the market go to 7.
This disconnect between what the Fed says and what the market hears can create a sort of economic telephone game where the original message gets distorted as it passes through various interpretations. Everyone played that game at camp. You would be like, the sky is blue. And then the person at the end would be like, I lost my shoe. That's monetary policy in a nutshell. And this is where President Goolsbee and the Federal Reserve in general draw a line in the sand.
And then there was a public debate about, well, does this tie the Fed's hand? Now they have to cut because the market expects it.
They insist on the importance of taking the Fed's communications at face value. The Fed is known for forward guidance. And this stance is crucial for maintaining the Fed's credibility and effectiveness.
You should take it at its word because there's only 8 meetings for the year. So if we go 2 meetings without cutting, it's not going to be 7 cuts. And the market is going to find out about that. You can you can try to fight the Fed. We have a board member who said he tells his employees, we can fight the Fed for as long as we want. The last time I checked, they're still undefeated.
If the Fed were to simply follow market expectations, it would essentially be ceding its policymaking authority to the market. And that probably isn't the best thing for economic health. It's not smart. While markets can push and pull, ultimately the Fed has tools at its disposal that no other economic actor possesses, like controlling the cost of money. But President Goolsbee, talking about his mentor, Paul Volcker, cautions against being overly reactive to these market movements.
And Paul Volcker, the great Fed chair, was my mentor, and I worked very closely with him during the financial crisis in 2008 and 2009. And he used to always say, our job is to act and their job is to react, and let's not get the order mixed up. And as I age, I find I'm more in agreement with Volcker every day.
Yeah, I know the markets tend to be kind of bossy.
If you faff around, you find out.
I couldn't have said it better myself. And of course, the Federal Reserve impacts the entire rest of the world. While the Federal Reserve's primary focus is on the US economy, its decisions ripple far beyond American borders. The yen has been moving quite a bit, and sometimes people call the Federal Reserve the central bank of the world just because the dollar is a reserve currency. It's extremely strong right now. You have Americans just flocking over to Europe. How do you think about the strength of the dollar in context of monetary policy?
The dollar policy for sure is being set by Treasury, and the Board of Governors is thinking about the international context.
The dollar status as the world's primary reserve currency means that the Fed's decisions they do have outsized impacts on global financial markets and economies. We can break this down. When the Fed raises interest rates, it doesn't just affect borrowing costs in the US. It can strengthen the dollar relative to other currencies, and that's why everybody's vacationing in Europe this summer. This has far-reaching consequences. Number one, for American travelers, a stronger dollar means more purchasing power abroad. If your friends are talking about going to Greece, lucky them. I wish I was going with them.
It's going to be a treat for people going to Europe or going to some country where if you had your heart set on visiting Japan, it's going to be cheap to Japan.
Number two, for developing countries that have borrowed in dollars, a stronger dollar can increase their debt burdens, which is not good. Number three, for global trade, changes in the dollar's value can shift the competitiveness of exports and imports worldwide. But President Goolsbee is quick to point out that the Fed's mandate is primarily domestic. The focus on domestic concerns is actually baked into the Fed structure.
Monetary policy, of course, affects the dollar. Now, the reserve banks around the country are formed, as you know, the Federal Reserve Act in 1913, then as now, the country was deeply suspicious that the whole financial system would be run by New York City and Washington, D.C. So they set up independence with a representation of voices from out in the flyover country and out in the rest of the U.S., and that's why we have the 12 reserve banks.
This decentralized structure was designed to prevent the concentration of financial power in just a few hands. It's a reminder that even as the Fed's influence has grown globally, its roots are deeply American. But what about the future, right? Some have speculated that the dollar's dominance might be waning, but President Goolsbee disagrees.
My old colleague Gita Gopinath has done this research showing it's not even going down. The use of the dollar as the medium of transaction and international trade between countries that are not the United States, between two countries, say in Asia or Africa, South America, the share of the transactions using the dollar, if anything, is rising. At the least, it's staying stable.
This ongoing dominance of the dollar in international trade underscores the continued global influence of Fed policy. When the Fed makes a move, the world still watches and reacts. But this global influence comes with challenges. How should the Fed balance its domestic mandate with its de facto role as an economic influencer? They're the most important influencer in the world. Despite these challenges, President Goolsbee remains optimistic.
And I'm closet optimistic we could keep some of that magic in 24.
This optimism isn't based on blind faith, but an understanding of the economic data that we're looking at and the economic cycles that we're going through and the resilience of the American economy. As President Goolsbee reminds us about vibes.
As you know, people's vibes are not totally what the aggregate numbers are, but the economy is never paradise. Even in the times, if they look back the late 90s, 1984, in a lot of big booms, they're always it's never the case that everybody's going to tell you, yes, this is what prosperity looks like.
At the end of the day, managing the economy is an art and a science. The dismal science, the dismal art, it requires interpreting imperfect data and making decisions in the face of massive amounts of uncertainty, especially this year. The data doesn't make sense, which is why we look at a lot of data points to figure out what is going on. We're getting closer to the golden path. Inflation is coming down, but there are some sticky parts. The labor market is showing signs of weakness. GDP came in softer. It's a normalizing economy, but as President Goolsbee said, there are warning bells. The Federal Reserve has big decisions ahead, and they will likely keep sniffing around. But the biggest question is, when will they begin to walk? And what will that path look like? And this episode was produced by me, Kyla Scanlon, and a big special thanks to Austan Goolsbee and the Federal Reserve Bank of Chicago for having this conversation with me. To learn more about economic data and methodology and its challenges, check out my blog, kyla.substack.com. I also wrote a book called In This Economy that talks about everything that we talked about in this episode. And you can check out my TikTok, my Instagram, and my YouTube channel, and my LinkedIn and my Twitter, where I post under Kyla Scan. Thanks for listening.